For many income investors, the mission is clear. They want cash flow, and they want a lot of it. And over the past few years, one product category has gained a lot of attention across Europe because of exactly that promise: covered call ETFs. These funds don't offer the usual 4 or 5%. They push out 7, 8, sometimes even 10%. ETFs like JP Morgan Global Equity Premium Income and JP Morgan Nasdaq Equity Premium Income have become crowd favorites. They pay high yields, they pay every month, and they look incredibly attractive at first glance. But there's a catch. When markets move up fast, these ETFs often fall behind and leave a big part of the upside untouched. Recently, iShares has entered the covered call ETF market and launched an interesting product that tries to reduce exactly this weakness. I'm talking about the iShares World Equity High Income ETF, also known as WINC. It only pays quarterly, but the strategy behind it aims to keep more of the market's growth while still delivering strong income. In this video, we'll take a look at what this ETF is all about and what makes it stand out. We'll also compare it directly with the popular JEPG ETF, which is basically its main competitor. And here's the twist. I'm usually quite skeptical about covered call ETFs, but I still opened a small position in WINC. In the final part of the video, I'll explain why I believe WINC could be a meaningful addition to my portfolio. Quick disclaimer before we dive in: this is not financial advice, just my own opinions and experiences. Let's kick things off with a few key facts about this ETF. It launched in March 2024, which makes it a very young product on the market. Since then, it has grown to around 180 million euros in assets. Not huge yet, but clearly moving in the right direction. Here you can see how the fund volume has developed over time. Since the ETF was launched, money has been flowing in continuously, which is a positive sign. The WINC ETF holds stocks from developed markets and uses the MSCI World Index as its reference point. But unlike classic ETFs that simply track the index passively, this one is actively managed, with a team deciding what to buy and what to sell. An expense ratio of 0.35% is standard for this type of strategy, and still quite reasonable. With more than 300 positions, the ETF is well diversified, and the portfolio includes both equities and cash positions needed for the active approach. And now it gets exciting, because this ETF pays out more than 9% in cash flow. At least that was the case last year, and unfortunately, that's the only data we have so far. The ETF pays in January, April, July, and October, which makes it a nice complement to many existing portfolios. But even with this unusual timing, it still means only 4 distributions per year. Many other covered call ETFs, however, pay monthly, which is a big reason why they are so popular. Let's come back to the distribution yield. How can this ETF generate so much cash flow? It does this by using call options. Only a small part of the payout comes from dividends. The majority comes from option premiums. If you've never heard of call options or premiums, here's a short and very simplified explanation. The ETF holds stocks and sells other investors the right to buy those stocks later at a fixed price. For this right, the buyer pays a premium up front to the ETF, and that premium flows directly to us ETF investors as cash flow. On the expiration date, the buyer decides whether they want the shares or not. If the market rises, they will exercise their right because they can buy the shares cheaper than on the open market. In that case, the ETF can only benefit from rising markets to a limited extent. If the market does not rise, the buyer simply lets the option expire, but the premium stays with the ETF and is passed on to investors. This is how covered call ETFs generate their high cash flow. The downside is the heavily limited upside potential. And this is exactly the weakness the iShares WINC tries to soften, with a second tool, futures. You can think of it like a binding pre-reservation on future market performance. WINC uses these futures contracts as a counterweight, so it can still capture part of the upside when markets move higher. It's a bit like the ETF buying a ticket for the next market rally. If the market really takes off, this ticket allows it to join the celebration, even though it sold calls beforehand. In the end, it creates a clever combination. The sold options generate the high premiums for the distributions, and the purchased futures reopen some room for upside. Whether this approach has worked so far, we'll see in the next section. Now, let's compare the WINC ETF with the JEPG ETF, since it's also an actively managed covered call ETF with a similar level of diversification across developed market stocks. JEPG is extremely popular among income investors, but unlike WINC, it does not use futures. When we look at the country and sector allocation, it becomes clear that both ETFs are very similar. JEPG is only a few months older than WINC, yet it has already reached a massive fund size and is now one of the most popular covered call ETFs in all of Europe. A big reason for that is simple. JEPG pays monthly, while WINC only pays every 4 months. Speaking of cash flow, both ETFs have a very short history, so right now it only makes sense to look at the year 2025. In that period, WINC delivered an incredible 9% in distributions, while JEPG paid only 7%. Of course, 7% is still a very strong result, and we don't know whether WINC can maintain 9% over a longer period. And now it gets interesting, because we're going to look at total return performance, meaning distributions plus price growth. Here we have a comparison that goes back almost 2 years, and we can see that there was a small market correction in March and April 2024. WINC recovered quickly, while JEPG is still struggling to bounce back and has not yet reached its previous all-time high. Let me add an MSCI World ETF as a benchmark, and we can see that WINC's total return performance actually kept up with the MSCI World. Interesting. Yes, I know, we're only looking at a very short time period, and things can look completely different in 3 or 5 years. But this is the data we have right now. To me, it looks like the combination of call options and futures is working quite well so far, and that's one of the reasons why I built a small position in the WINC ETF. I'm curious to see how this ETF develops over time. If you enjoy my content, a like and subscribe means a lot. Thanks. Let's be honest, this kind of massive cash flow never comes without trade-offs. So let's take a moment to talk about the potential risks of this ETF. Unlike a classic passive dividend ETF that simply tracks an index, here we're dealing with a rather complex financial product, and a few things immediately come to mind. First, it's a covered call ETF, which means it might lag behind the market during strong bull runs. Yes, the management team tries to counter this with futures, but futures are sophisticated instruments, and we simply don't know whether this approach will work well over the long term. Speaking of futures. Second, futures may sound promising, but they add another layer of complexity. We don't know whether this will perform reliably over many years. Third, the ETF is actively managed. Fund managers constantly need to make decisions, buying and selling stocks, writing options, and managing futures positions. A long list of choices that must be made continuously. But can fund managers consistently make good decisions over decades so that the ETF can at least keep up with something like the Vanguard FTSE All-World High Dividend Yield ETF? After all, fund managers are human, and humans make mistakes. Yes, I know that today most of this is supported by statistical models and automated algorithms, but that doesn't make it simple. And who will manage the fund in 20 years? AI? These are all uncertainties that come with complex products like this. A classic dividend ETF, let's say the Vanguard FTSE All-World High Dividend Yield, only pays a bit over 3%, but I can hold it for 30 years without worrying because it's simple and doesn't require active management. So, why did I buy the WINC ETF? Well, I've always found covered call ETFs quite appealing when it comes to cash flow. For a while, I had been thinking about investing a small amount into one of these ETFs just to see how it feels in practice. My biggest concern was always that my portfolio would constantly sit in the red. But the new covered call approach we discussed earlier, combined with futures, sounds very promising to me. I simply want to test how this develops, and maybe I'll end up being positively surprised. Maybe the ETF will outperform JEPG. Maybe it will even keep up with the MSCI world to some degree, or maybe not. But I'm curious to find out. Another reason I bought the ETF is that I believe WINC could be a solid addition to my portfolio. In my last video, I showed you my portfolio. One of the big weaknesses is the relatively low dividend yield. To boost that yield, I opened a small position in the WINC ETF and invested a few thousand euros. Over time, I plan to grow this position to around 10% of my portfolio and closely monitor how performance and cash flow develop. If the total return and the cash flow convince me over a longer period, I could even imagine increasing it to 15 or maybe even 20%. Speaking of cash flow, as mentioned earlier, WINC doesn't pay monthly like most other covered call ETFs. It pays quarterly. I know many investors avoid it for that reason alone, but guess what? Some people actually prefer it that way, and I'm one of them. With this ETF, my cash flow calendar now looks like this. For me, it's a perfect fit. So, what do I expect from this ETF? In concrete terms, I expect at least 7% in distributions and positive price growth. Because let's be honest, with products like this, you want to collect strong cash flow while keeping your investment value intact. So far, the ETF has held up well, but I'm watching very closely to see how it develops and whether it meets my expectations. If I notice that it doesn't deliver, I won't hesitate. I'll sell the ETF and move everything into a different one. And now I'm curious. What do you think about this ETF, or covered call ETFs in general? Do you use them as a small addition in your portfolio, or as a core investment? Feel free to share your thoughts in the comments. That's it for today. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.